Testing, testing, 1, 2, 3. All right, all right, all right. Good morning, good morning. How are you guys all doing today? I have a special presentation for you today. I promised you yesterday during our live class that I was going to do the seasonal nature of markets today. I promised to do it yesterday, but we're going to do it today because yesterday we got busy trading, and I need to pull up and show you how we did yesterday. We had a pretty good day trading. Closed out some options, but today we're going to focus a little bit on the seasonal nature of markets. Now, I know the markets are getting ready to open right here. We've got the opening bell coming in about 3 minutes. So I do want to watch the opening bell before we get started with our presentation into the seasonal nature of markets. But we need to not spend a whole lot of time watching the morning bell, just simply because we got a lot to go through. And I want to get over to the stocks market. And remember, we also did Jim Cramer's stuff the other day in the stock market. We want to look at that. We've got so many things to do today. I got lots of things on the agenda. So we're going to watch the opening bell and get that started. This is the futures market that we're looking at here. Up in the upper left-hand corner, we have the S&P 500. In the bottom right-hand corner, we have the NASDAQ 100. In the top right-hand corner, we have the Dow. That's the mini Dow. And in the bottom left-hand corner, we have the mini Russell. In the bottom right-hand corner, we have the micro NASDAQ. And the micro NASDAQ is 10 times smaller in leverage than the minis. And we got the mini up in the upper right corner. This is the mini Dow, mini S&P, mini Russell, but the micro NASDAQ. Now, why do I make the NASDAQ micro? Well, because it is a big market. And sometimes I get a little carried away, admittedly so. And so when I start trading the NASDAQ, I want that to be kind of a little bit calmed down, not quite so wild and crazy, because it is such a big market. And I get a little crazy, and sometimes we have to calm that market down. So for those of you who also want to have a calmer market, you can use the micros, and that's also here for an example, so you guys can see how this works. All right, so you can see the micro as well. Now, the quick and skinny on this is that from this point to this point, just to quickly draw in there, that was a $160 move. You're like, $160 move, land? Wow, that's pretty nice. Yeah, how much did you have to put in to make that? Well, we're in the futures market, so we only had to put in $1,000. What? $1,000 to make $160? How much? That was a 1-minute chart. That looks like about 15, 20 minutes. Yeah, $160 and 15, 20 minutes on a $1,000 trade. And that was pre-market session. So that's how this market works over here. Well, show me that over there on that micro that you've got there. Okay, let's look at the micro. So we come in here and this move on the micro, that was $33. And how much do I have to have on that? $1,000? No. To do that one, to make that $33, you'll need to have $100. So you made $33 on a $100 investment. If you'd have put 10 of them in there, if you'd have put $1,000 in there, you'd have had $335, which would have been the same thing as doing a single mini. All right, it's 10 times smaller, so you can break it down into increments. And that's what's nice about the micros. All right. So we're going to go, I'll just do the same thing from this low to this high, just to show you that trend. That was $73 on a $100 investment from bottom to top. All right. So that's how this market works. It's got some pretty good leverage. That's why we love it. That's why we day trade it. And that's why we're here. All right. Looks like the market's getting ready to fire off. So it is 7:29 and we have 37 seconds left until the bell. So this is the stock market bell. Now, of course, in the futures market, we are trading a 24-hour market. And this baby runs, well, actually 23 hours. We do close it for an hour every day in the afternoon around 3 o'clock. Depends on your time zone. But, you know, we close it for about an hour. And that's where we do our accounting and do the mark to the market stuff. Make sure everything's all straight. Everybody's dollars are in the same spot. And then we open it back up again and away you go. All right. So you can trade these things 23 hours a day. And since we only close them in the afternoon, there is really no opening bell session for the futures market. But since we're trading the stock indexes over here in the futures market, there is an opening bell. It's the opening bell of the stock market. So here we go. And off goes that Russell once again. Yesterday, we saw that same thing right out of the gate. Russell took off like a banshee right out of the gate and just took off and went straight up, didn't it? So here we're getting a little bit of a whipsaw here on the Dow. Dow's breaking lower after it broke higher here, came in, rallied up, flushing back down. So we're going to kind of watch these things flush around a little bit. We want to kind of sit on our hands here at first. You can jump in on these if you want to, but it's a little dangerous. Just keep that in mind because we don't know exactly which direction it's going to go right out of the gate. Usually it just kind of pops all over the place. Now, on occasion, you'll get one that'll run straight right out of the gate and just go in the direction. Yesterday, that was the Russell. Remember, Russell just took right off and went to the moon. It was a big straight up move and right out of the gate. And so we may get that same thing again today here on the 1 minute chart. Notice that these are the 1 minute charts. Oftentimes we'll look at the range bar charts, but today we are looking at the 1 minute charts. Let me bring this thing up here a little bit full screen so you can see it a little better. And that is what's going on in the stock market right now. So the Dow's flushing, the Russell, the small caps, they're rallying. We got the 15-minute chart up here in the S&P. This is the 15-minute chart because I like to trade options on the 15-minute chart, right, on the S&P. So this is where we'll trade our options. This is where we day trade. This is where we day trade. This is where we trade the minis. So we kind of primarily trade, we kind of trade all four markets, don't we? But this is what we're watching right now. I don't like to see them going in different directions. I don't like to see one going this way and one going that way. I like to see them all doing the same thing. I call it porpoising. And if they all go the same way, you usually have a lagger. He kind of follows a little bit slower, and that's one I like to jump on. We jump on that little guy, and he follows up with the rest of them. So when they're doing different things, you kind of have to go, wait a second, why are they doing all these different things? Kind of want to wait until they're all doing the same thing and then take that lagger. That's how we made money yesterday. That was a good trade. I think we did that on the Dow, if I remember correctly. We took the lagger and it made one. And then we took some on the Russell, I think, too. We made some money on the Russell. So yesterday was a good day. And then we had our options pay off yesterday as well. So that paid off well, too. So, all right. So watching the NASDAQ flush, not ready to jump in the market. You always feel bad when you see something like that Russell coming in there, just going straight right out of the gate, just like that, and going to the moon. Well, how much money was that, Land? Well, if you'd have got in on that crossover on that yellow dots up to where it's currently trading, well, to the peak. Let's just go to the peak. That was $365 on a $1,000 investment. That's pretty damn good. Oh, I just said the swear word. Now I'm going to have to go confess my sins to YouTube. Okay, here we go. So that's $140 is where it's sitting right now on a $1,000 investment. So it flushed back down quite significantly there, and that's why I kind of warn you that these markets first thing in the morning are a little bit choppy, so you have to be careful. There's a $370 move all the way back down to $135 move here on the Russell. So we're breaking lower, breaking a new low. So we want to be careful. Watch these babies. Are you going to trade them, Land? Are you going to trade them? No, I'm not going to take a trade today. We're just going to watch them for a minute because I got a really important lesson I want to teach you here after these things calm down just a little bit. We're going to have the seasonal nature of markets, and I think you're going to really enjoy what we've got for you. Great presentation, great software, great fun stuff. We're going to go over and look at the stock market. Look at that Dow flushing down, S&P flushing down. You'd come in here and put an option in here. Watch this. We'd come in here and buy a put. Just like that, buy a put, right? Oh, not on this market, this one here, buy a put. And we could drop that right in there, and we could drop that in and see if that market wants to continue to flush down. You think it's going to continue to flush down, Land? Oh, I don't know. I think it'll probably come down here to this blue line and start to bounce around a little bit. So I'm not thinking we're going to flush out of here. We might, I don't know. You know, this first morning bell thing doesn't give you a whole lot of information to run on other than just whips on back and forth. Not ready to put this on yet. I just wanted to show you that's how you do it if you wanted to. This market looks like it wants to make a little ABC pattern. If we came in here with a little ABC tool, we go A, B, C, and we'd anticipate the next leg up. If this thing would break a new high, first green candle to break a new high, we'd take a long position up out of here. So that's what we'd be looking for there. Otherwise, we're going to look for it to flush back down and touch that blue line. All right, that's the VWAP, the magic blue line. It's like a rubber band, pulls the market to those levels. Look at that Dow still flushing down. We're getting the same thing as yesterday on that NASDAQ, aren't we? On the NASDAQ, we're getting just kind of a nowheresville market right here going out on the end. It's just kind of doing nothing. It's just kind of staying flat. We got that same kind of a pattern yesterday, didn't we? You just got nothing out of the NASDAQ, and then suddenly it decided it wanted to flush, and flush down it went. Do you remember that? Look at that Russell still flushing down. Now, yesterday it took off like that and just went straight up. It never gave us an opportunity to get into it. It just went straight up, and we were over here trading the Dow, of course. So look at that Dow. It's flushing down. give you a little bit of commentary here as these markets move around. We're going to jump over and get into our presentation. We're going to go ahead and I'm going to hit save on this, and I'm going to close that out. And we're going to start off with finding the best times to generate income in the financial markets. All right, that's our goal today. And we're going to do that in the seasonal nature markets. And we're going to go over and look at the stock market, because we're going to look at the stock market today. And then we're going to go over, and if we've got time, we'll go check out what Kramer did and those orders we put on Kramer and see how Kramer's doing. But for now, we're just going to go do our seasonal nature markets. And I want to give you a little quick introduction. There's some people who, we got a lot of new people coming, and I want to make sure you guys all realize that it'd be great if you would subscribe to our YouTube channel. I noticed that about 75% of the people who come and attend these lessons don't subscribe. So subscribe. I know you're returning. You're coming back all the time. Just go ahead and hit that subscribe, and it'll make sure that you're part of the club. All right. So we want to get you part of the club. So let's get rocking and rolling here. So find the best times to generate income in the financial markets. And that's what we're all about, right? So the next thing we want to do, if I can make this thing, there we go, spinny. Who is Lan Turner? Let's just give you a real quick introduction who I am and why you want to be here listening to me. Not that, I'm so handsome. It's because of the brain. I've got a good brain, just like what is Donald Trump. I got a good brain. I thought that was kind of an odd thing to say. Don't you have a good mind? I don't know. Anyway, I'm an active trader, been working in the financial industry for over, you know what? I had to update that. I just turned 60 and realized, man, I started trading clear back when I was in my mid 20s, and I started doing this as a career when I turned 30, and I'm 60. Oh my gosh, I've been in the financial industry for almost 35 years, trading stocks, futures, and Forex. Now, of course, I have futures in here. I listed as the big one there because my favorite thing is the futures market. I love the futures market. Not that I don't love stocks, not that Forex isn't pretty cool too, but I love the futures market, and that's my little bailiwick down there. All right, so I am a futures guy. Now, how come I can't get my mouse to work? There we go. All right, I'm worked at the Chicago Board of Trade, Chicago Mercantile Exchange Education Centers as a guest lecturer on numerous occasions between 2000 and 2010. That's where I spent a lot of my time getting my feet wet in the Chicago markets. Between 2000 and 2010, I was an educator there, and I would teach and lecture, and I worked with a whole bunch of other great, wonderful educators, teachers, and lecturers, and I met some amazing people there, had some great contacts, really some great friends, and they've kind of shaped my life ever since. And so that's been something that I've been very proud of. Spent that much time back there working at the Chicago Mercantile Exchange Education Centers. So that's a little bit about me. While teaching the Board of Trade and the Mercantile Exchange, I authored several books, co-authored numerous books and courses on trading. So there's my latest book, Stock Market Playbook of Strategies. You can go get that on Amazon right now. So it is available on Amazon. Just search Lan H. Turner, and that baby will come right up. All right. I'm a public speaker, teacher, and educator at national symposiums such as the Traders Expo and the Money Show. Regularly go out and teach out in Money Show symposiums. And so that's a lot of fun. I love doing that. That was me, by the way. If you couldn't tell. See that? That's me. I was skinnier back then. That was last year. All right. Teacher, taught 17 years at the university level so far. So I'm currently teaching at Dixie State, actually. Dixie State University, Utah State University, University of Puerto Rico, and Bridgeland Applied Technology Centers. We just recently changed the name of Dixie State University over to Utah Tech University. So that's the universities I've been teaching at. I taught at Utah State for 12 years, and I've been teaching here at Dixie State for, man, this is like my 8th year teaching here. So been teaching at the university level for quite a while. Started doing that teaching after I left the Board of Trade. All right. So I'm an entrepreneur and business owner. I own Gecko Financial Services, which is a futures and Forex brokerage firm. That's my firm. That's my headquarters right there. That's my building. So we got Gecko Software, trading software developer. So we develop trading software. And so we're going to go and play with some of that today. That's kind of what we're going to do. Pitt News Press, financial education publisher. So we also have Pitt News Press, and that's where we do Pitt News Magazine. Right up there in that little loft. That's the headquarters for Pitt News Magazine. That's a great little place to work. And then we got real estate investor, both commercial and residential. And of course, this is my commercial building, one of them. And so there we go. And that's a little bit more about me. This is the software that we design. I'm the design engineer for the 7 time Stocks and Commodities Annual Reader's Choice award-winning live trading platform known as Track and Trade Live Stocks, Futures, and Forex. So it's a great piece of software. This is the software we use here in this YouTube channel. It's a wonderful piece of software. 7 time Stocks and Commodities Annual Reader's Choice Award. So everyone will be offered these live trading platforms for the duration of the class if you so desire. Come on over and get it. You can get it for 2 weeks for free, and then come and join us here at YouTube. All right, and we'll help you make it happen. That's what we do here. But the software we're going to talk about today is another software program that I designed. We got Chart Miner, we got News Miner, we got Trade Miner. And Trade Miner is the one we're going to focus in today. It's the seasonal nature of markets, and it's how we're going to unlock Wall Street's calendar. All right. So these are other software programs that I've designed. And I have a question for you. That's enough about me. Let's talk about you. All right. What are your financial goals and aspirations? How are you going to reach those goals? If I were to ask you, where do you want to be in 12 months from now when it comes to your trading? How would you answer that question? That's an important question. What are you willing to do to achieve that goal? You know, everybody wants change. Who wants change? See the little cartoon? I thought that was great. And then when it says, who wants to change? Nobody raises their hands. Everybody wants change, but nobody wants to change what they're doing. Right? We all want change, but nobody wants to change. So if I were to ask you where you want to be in 12 months from now with your financial goals, what would you say to me? Do you really want to do anything else or not? Are you going to really jump on that pogo stick and make that happen for yourself? Or are you going to go and watch some more, football and basketball? I don't know. So I can't answer that for you, but I would assume that the reason you're here is because you've already made that decision that you want to make this happen for yourself. So go ahead, pat yourself on the back. Don't break your hand doing it, break your arm doing it, but go ahead. I think you should be proud of yourself for being here because this is tough stuff. All right. If it were easy, everybody'd be doing it. All right. Let me have a little drink of tea and then we'll get rocking and rolling here. All right, let's try to solve some of the biggest, the world's biggest problems. All right, biggest problems traders have anyway, and that's finding the right market to trade at the right time. Timing is everything, right? The right market to trade at the right time. When is that market going to go up? Let's talk about that. Y'all remember that good old guy named Donald Rumsfeld? Donald Rumsfeld, whether you liked him or not, I don't know. Doesn't matter, but he did have a great saying, and he said, there are known knowns. There are things we know that we know. There are known unknowns. There are things we know we don't know. But there are also unknown unknowns. There are things we don't know we don't know. All right. I know that's kind of a fun little saying. I love it because there are a lot of things that are unknown unknowns, things that we don't even know we don't know. And especially in the financial industry. The financial industry is huge. There are so many things. I've been doing this for 35 years and I still feel like I'm just barely scratching the surface of what's available to go out and do in this financial world. You really have to kind of verticalize yourself, pick one thing and say, I'm going to just really get good at that one thing or those two things. So that's what I've done. I kind of specialize in a couple of areas, and that's where I've been able to find my little niche and been able to have some success, find some traction. All right. So if you try to do too many things, you're going to go crazy on you. All right. So the first thing we know, these are known knowns. All right. Now, if you've been attending my classes very much in the past, you know all this stuff because I talk about this stuff all the time. Technical analysis. That's kind of my bailiwick. That's what we do here. We trade a lot of known knowns. Head and shoulders, ABC, 1, 2, 3, top and bottom formations. ABC land, ABC, candlestick formations, hammers, hanging mans, etc. You've heard of these things. These are known knowns. You as a trader, you don't have to spend much time in the financial industry and you'll know these things because there's some of the first things we always teach. All right. All right. There's also things we know we don't know. So these are known unknowns. All right. Now you know about them. You just don't know about them. All right. Have you ever heard of these patterns? Sell in May and go away. Yeah, that sounds familiar. I've heard that before. What about seasonal sector rotation? Oh, yeah, I've heard of that one. What about triple witching? Oh, yeah, that sounds familiar. What is it? I don't know. It's an unknown. I know about it, but it's an unknown. What about the Santa Claus rally? Oh, yeah, I've heard of that one too. But what about that January barometer? Oh, I don't know. I've heard of it, but I don't know what it is. So these are your known unknowns. All right. These are not what we're going to talk about today. I will say I am working on a beautiful section in Pit News Magazine that's going to cover these types of things, these known unknowns, because they're very important. And in fact, in Pit News Magazine, that's coming out in the, what's this coming up month? Just this February. So in the March issue, we had a specific section where we talk about some of these different. We've got the March known unknowns. All right, the March pattern for the month of March, and you're going to want to know that. So if you don't have it, go over and get yourself Pit News Magazine, pitnews.com, subscribe, and you're going to get that unknown for the seasonal rotations for the, what is it? It's the Lion and the Lamb strategy that's that we do in the month of March. All right. Now we also have unknown unknowns. All right. These are the things you didn't know you didn't know. So there are things we don't know we don't know. What about these patterns? Have you ever heard of the DE or the John Deere rally? Never heard of that one. Don't know what you're talking about there, Lan. What about the KO or the knockout rally? You ever heard of the knockout rally? KO, that's the symbol for, you all know, Coca-Cola, right? So you ever heard of the Coca-Cola rally? No? How about the soybean rally? You ever heard of that one? Well, that's kind of not got a cool name to it. We got to make up a cool name for it. It's the soybean rally. You ever heard of it? No, never heard of them. These are the patterns we're going to talk about today. Today, we're going to talk about the unknown patterns. All right. Let me ask you a quick question. If you were a farmer, when would you tell me that the prices of your, in this case, corn, your corn prices are at their lowest levels? Think about it. If you're a farmer, when are the prices at their lowest levels? That's a pretty simple thing to say, Lan. I'm not sure if I'm right. I'm going to kind of throw a dart at this. Probably when I have the most of it, right? Which would be harvest. Okay, you're right. That would be when a farmer would tell you that the prices of corn are at their lowest prices, when he's harvesting them, when he's got the most of it, when there's more of it out there, supply and demand, right? So he's got a lot of supply, so the prices are going to be lower during harvest. Now, that one little piece of information right there, that's very powerful for you. If you're a corn trader, you're going to be looking to buy corn at, if you want to buy low, sell high, right? You want to be buying corn when he's got the most of it, when it's harvest time, because then the rest of the year next probably going to go up from there, right? It's probably going to get more expensive. So that's kind of the idea. This is the seasonal nature of markets. Now, there's all kinds of seasonal trends that occur. What about the, we got the corn, we got soybeans, we got sugar, we got gold, we got silver, we got crude oil. There's all kinds of different seasonal events that occur in the futures market that are easy to understand why these markets might move like that, right? We got other sayings that are things like knee high by July. Why do we say the corn needs to be knee high by July? Well, that's because crops in particular, if you're trading commodities, are very seasonal in respect to how we plant them, harvest them, and when they're susceptible to things like damage. These all come at the same time of the year. We plant them at the same time of the year. We harvest them at the same time of the year. They're susceptible to damage at the same time of the year. Too much water, not enough water. And these are annually produced commodities that have annual events. So these annual events, we put them on a calendar and we say, hey, this is when this is occurring. This is when this is occurring. This is when this is occurring. And the markets react year after year after year after year, basically the same every year, depending on how these things are turning out. And so we can look back in time and we say, hey, there was flooding at this time. That means the price is probably going to do this because this is what it did last time. So we can come in and we can say, well, if the crop is not knee high by July, well, we're in trouble. It needs to be at least knee high by July, because if we're not, hey, we're going to probably be scooting that harvest into the wintertime, and we may not have a good crop. And that's going to tell us something, right? It's a calendar event. So this is what we're going to be looking at today. All right. Let me give you some additional seasonal historical repeating cycles and trends that you can take into consideration. Since 2003, gold prices have spiked higher 86% of the time in the month of February. Did you know that? 86% of the time. Now, gold is not planted or harvested at the same time every year. This is what we call a perpetually produced commodity. It's a mined operation. So we pull gold out of the ground 12 months out of the year, but we've definitely got some very seasonal events that occur in gold. It's a little beyond the scope of this discussion right now, but I will mention that one of the biggest times that we trade gold, what do we use gold for nowadays? We don't really use it in industry. It's too expensive. It's more like a currency nowadays, isn't it? But when do people buy gold? Generally Christmas time. Right now, gold is kind of it's a trinket. It's a jewelry. All right. Other than the currency side of it, it becomes jewelry. And so we sell a lot of gold in Christmas. So there's a big buildup to the gold producers who are selling their gold to the gold manufacturers who are going to make jewelry for it. Now, this is the wholesale industry. So what happens, a couple months before October is a good time to be watching gold rise because they're buying a lot of gold to make the jewelry to sell them in Christmas. All right. So keep that in mind that gold prices have spiked higher 86% of the time in the month of February. Now that's after it's over. So you have your gold rush up into December, and then it flushes back down into January. And then in February, it starts to rally once again. And that's what's happened. 86% of the time in the month of February, gold has risen in price since 2003. Since 1997, soybean meal prices have spiked higher 77% of the time in the month of July. How about that? How about since 1982, U.S. hog prices have spiked higher 76% of the time between February and March. That's important to know. That's a seasonal event. That's an unknown unknown. Well, I'm revealing it to you. So for now, for you, it's a known known, all right? Or at least a known unknown. How about since 1982, coffee prices have spiked higher 76% of the time in the month of August. Now that's pretty cool. In August, where are you going to be looking? If you want to trade some coffee, I think I'd be looking at those coffee prices right there in the month of August, because 76% of the time since 1982, those babies have run in the month of August. All right. Let's give you a couple more, additional historical repeating cycles and trends, because not only does this happen in the futures market, it also happens in the stock market. Now, a lot of people will say, hey, there's no seasonal nature of markets in the stock market. That's just simply not true. They are very seasonal. In fact, they're almost more seasonal than futures, believe it or not, because this futures is so well known. They've kind of been worked out of it a little bit because we know about them so well, but people don't know so much about them in the stock market. They're still kind of a new and exciting thing that's happening over there. And it takes special software, AI technology, that allows you to figure these things out. Since 2010, Fortnite Inc. has climbed on average 14% in the month of February, 92% of the time. That's Fortinet, whatever they do. I don't know. It's an unknown unknown. All right, since 1990, Best Buy has climbed on average 10% in the month of March, 76% of the time. How about since 1995, McKesson has climbed on average 9% in the month of May, 86% of the time. There's some very seasonal stuff going on out here. Since 1984, AMD has climbed on average 10% in the month of September, 77% of the time. Since 2013, Match Group has climbed on average 26% in the month of December. How about that? Did you guys know that? There's very seasonal nature to the stock market. Now, why might that be? I'm sure you can come up with a couple of ideas. I mean, we've got things like holidays like Black Friday and Christmas, right? Those are obvious seasonal nature of markets. Okay, but what about fiscal year end taxes? We got taxes that come same time every year. What about quarterly earnings reports? Same time every year. Scheduled dividends, same time every year. Annual industry cycles every year. Corporate obligations, same time every year. All right, so you get on these cycles and these trends, and this is what happens in these financial markets. And these markets, Wall Street knows about these. All right. Wall Street knows about these. And in fact, they have a calendar, and they go out and they say, hey, it's time to buy XYZ because of this reason. All right. It's time to buy XYZ again because of this reason. And they have different stocks that are going through different seasons and different times of the year that they'll go through and put this out there. So it's very cool. So let's go look at a couple more. Hold on one second. All right, let's go in and look at one more. How about this one here? This is the John Deere rally I mentioned earlier. We call this the DE, or the John Deere rally, because between October 23rd and November 27th, every single year, 100% of the time over the past 20 years, back to 2003, John Deere, or DE, has risen in price on average 12% in only 66 days. Using options, that could be over 200%. We call that the DE, or John Deere rally, all right? because between October 23rd and November 27th, 100% of the time over the last 20 years, that baby's risen in price 12%. Can you believe that? That's unbelievable. Here it is. John Deere equity graph chart, October 23rd through December 27th, 2020, 2023. There it is. All right. Let's look at this one. If you'd have done this, this is what your account would have looked like. All right. So this is your equity graph. So that's the John Deere rally. All right. Here's another one. I just wanted to say, past performance is not a guarantee of future success. Now, we have to keep that in mind. Just because John Deere has risen in price 100% of the time, or 20 times, actually 21 times out of the past 21 years during these 2 dates without fail so far, does not necessarily mean it's going to do it again this year. You have to remember that. All right. This is past performance. Now, that said, good old Warren Heisenberg, you guys all know this guy. Heisenberg, you watch that TV show, you know who Heisenberg is. A German theoretical physicist and one of the key pioneers of quantum mechanics. He said, because of our limited observation skills and tools, we can only infer from the past experience and knowledge what is about to happen. So we know that past performance is not necessarily indicative of future results, but it's the best information that we've got. All right. We have to look at the past to know how to deal with future. And we do that in all industries. I mean, yeah, that's why you have a resume, right? You go get a job. The reason you have a resume is we're going to look at your past performance to see how well you did in your past jobs so that we can see if we're going to hire you for the future position. All right. Baseball players, who are we going to put up on the screen? We're going to put up the best guy, the guy that's got the highest RBI. And we're going to stick him up there when we need a guy to knock it in, right? That's how we do baseball. How about basketball? Who are we going to stick up there on the front lines? We're going to stick old Michael Jordan up there, right? When we're in a clutch situation. Why? Because past performance proves that he's the guy we want to give the ball to. What about a car? We go out there, we're going to buy a car. We want to go look at Carfax, right? Because we want to see if that car's been wrecked and why it's sitting on the lot for the price it is. So we look at past performance to see what's going to happen in the future all the time with all kinds of industries. It only makes sense that we do it in the stock market. What have these markets done in the past to make us think that they're going to move one direction or the other in the future? We use that in technical analysis all the time, right? We're looking for those A, B, C, D patterns. The market rallied, pulled back a little bit. Now we're going to expect it to rally again. All right. That's past performance. We're using past performance to give us ideas of what the market's going to do in the future. All right, soybeans. This is the January soybean rally that I mentioned. All right. Between October 5th and October 18th, 14 calendar day period, 2 weeks, almost every single year, 93% of the time over the past 14 years, back to 2009, soybeans have climbed in price on average of 93% return on margin. Now, that's unbelievable. That is a crazy, crazy thing. So that's your soybean rally right there that we talked about. Uh-oh, what happened? All right, here's the next one, Coca-Cola. I mentioned that one earlier. So here's your Coca-Cola rally. All right. What's going on here? Trying to figure this YouTube stuff out. All right. We call this the KO or the knockout rally because between March 22nd through April 14th, almost every single year, 90% of the time over the past 21 years, back to 2002, Coca-Cola has risen in price on average 4% growth in only 24 days. Using options, this would be over 75%. So we call this the KO or the knockout rally because between March 22nd through April 14th, almost every single year, 90% of the time, that baby has risen in price over the last 21 years. Can you believe that? Unbelievable. Now, if there were any credibility to this, it would be doing it across industries, right? So you'd say, well, if it's doing it in Coca-Cola, is it doing it in Pepsi? Well, it sure is because we have what we call the pep rally. All right. We call this the pep rally because between March 22nd through May 25th, almost every single year, 91% of the time over the past 23 years back to 2000, Pepsi-Cola has risen in price on average 5% growth in only 68 days. Using options, that would be over 75%. That's the pep rally. And that's pretty interesting because between March 22nd through May 25th, almost every single year, 91% of the time over the last 23 years, we've had a pep rally. Just like in Coca-Cola, March 22nd through April 14th, almost every single year, 90% of the time over the past 21 years, that baby's risen in price. If it's going to do it in Coca-Cola, you would definitely think it's going to do it in Pepsi. And if it does, hey, that's got to be a little bit of evidence that there's something to this. All right. So let's go and cross industry. And I thought that was pretty cool. Now, the information that I've just told you has been published in all kinds of information, all kinds of publications. These rallies that I've got here that we found, we published this in Barron's, we've published it in Stocks and Commodities Annual magazine, we've published it in Futures magazine, we published it in Investors Business Daily magazine, we published it in Pitt News magazine, and in fact, it's published in Pitt News magazine. In the March issue, we got 3 more trades coming out for you in the March issue. We stick 3 trades in there now, every single magazine version. Now, those are valuable if you ask me, and we're going to do all the work for you to find them and give them to you in Pitt News magazine. You're going to want to subscribe to that. Now, these are these unknown unknowns. The problem with seasonal cycles and trends is that if you don't know about them and you start trading and you're trading against one of these seasonal cycles and trends, it's like trying to walk up a down escalator. You ever done that? Try to walk up a down escalator? That's what it's like trading the financial markets against these seasonal trends. If you're not aware of the seasonal trends and you don't know that these markets 80, 90% of the time over a specific time rate are rising in price and have done so during that time frame, man alive, you don't want to be buying those things or taking short positions on it. Or we can look at them to see how many times they fall too. And we do that all the time. We're like, okay, these are stocks you should not be trading in the month of March. Why? Because they 90% of the time during the month of March, they fall. And that's almost more valuable than telling you the ones that are rising. Because if we're going to go out there and we're going to start looking to buy some stocks, we want to make sure we're not buying ones that are in a seasonal cycle failure, right? We don't want to be buying stocks that seasonally cycle and fall during a specific time frame. And we're looking to take this thing long. That's not a good thing. It's like trying to walk up a down escalator. That's really hard to do. So that's great information to have. And we have both sides of that. All right. Now, you could build your own spreadsheet to do this. You can go back and take all the data and build all these big spreadsheets and these little turntables and everything and update that spreadsheet and do all that work yourself if you want to. Heck of a lot of work. I mean, you can imagine how you might have to do that. You're going to have to get all that data for every single day, for every single month, for every single year, line it all up, get those things, do all your calculations. What a nightmare, right? That'd be a lot of work. But you don't have to do that because you know what? At this point, I could probably offer you a $2,000 a year newsletter subscription service stuffed with these types of recurring seasonal trades. And you must admit it would probably be worth the money, right? But I got a better idea. I'm going to introduce you to the software that does it. It's called TradeMiner Pro. TradeMiner Pro is a software that finds these trading opportunities in both the stocks and the futures market. Right? And that's what we're going to go trade and play with today. Let's jump on over and remind you one more time that this is where we get all the information to publish in these different magazines. They've all been published. These results have been published in all these magazines, plus a lot more. I got something else. I think I'm okay to tell you this. We've got a customer, a hedge fund that uses this software. They're a multi-billion-dollar. Well, I don't know if they're multi-billion. They're multi-million. They're a billion-dollar hedge fund. Multi-billion would be have more than 1 billion. I don't know if they have 2 billion. I think they're a $1 billion hedge fund. We've got a $1 billion hedge fund that uses this software. I'm not lying. That's true. $1 billion hedge fund uses this software. They subscribe to it. All right. So TradeMiner Pro research software. That's the name of the game. Let's pop on over and let's get busy trading with TradeMiner Pro. We're going to go look and see what trades it tells us to look for in the month of February, actually March. All right, so let's get rid of this. And here we go. This is March. All right, so we're going to come in here and I'm going to pull up. That's actually the track and trade software. We're going to go and review what it tells us to trade. So let me pull up the TradeMiner. There it is. There's TradeMiners. This is what TradeMiner stocks looks like. And you can see up here in the top left-hand corner, it's an AI system. It's built around AI. It's got the neural network here on step 2. And it's got a powerhouse research tool here on step 1. So you see up here in the left-hand corner, you got step 1, step 2, step 3, step 4. You go into your alerts, you got settings, you got education, all kinds of fun stuff. Now, what we're going to do is we're going to search the S&P 500. All right, we got a lot more in here than the S&P 500, and you can do all kinds of criteria to find all kinds of stocks and then have it search through those lists. But we're just going to do this S&P 500. So I'm going to come back here to the search list, and I'm going to come up here to the top, and I'm going to read the prompt. Now, if you're familiar with doing AI stuff, you know you have to give it a prompt. You have to prompt the AI. So here we go. Search for trends, Mr. AI, in the month of. Now, we can do symbols if we want to, and that's a little bit different type of analysis because we just look at the seasonal nature of an individual stock, and we can do that. But that's not what I'm going to do in this example. This example, we're just going to find month. We're going to do month. We're going to find all the stocks in the whole S&P 500 in the month of, and we're going to pick March right here. Find trends that have won at least 80% of the time. Now, is that good enough, or you want to do 90? Or do you want to do 100? You can do 100% of the time if you want to. I'm going to leave that up to you and let you do that one yourself. I'm going to put it in here at 80. So we're going to do find trends that have won at least 80% of the time, showing both. And we could do both bullish and bearish. And that's the way we could find out. If we do bearish, we could find out that stock's not to buy. Doesn't mean we're not to trade them, because we could short them if we wanted to, right? We could buy some put options. That's very popular. A lot of people like to do that. So we could do bearish and just see which markets are going to fall during a specific month. So which markets should we not be buying in the S&P 500 of the S&P 500 stocks? Should we not be buying in the month of March? Because they generally fall. That's what we would do. We'd choose bearish. But in this case, we're going to do bullish. We're going to find out which ones we should buy. All right. So which ones should we buy? List trends at least the last 10 trading days, but no more than 30 days. So that's kind of a nice window. Now you can open that window up and make it longer if you want to. You can short it down, make it shorter if you want to. I like kind of a 10-30 mix. That's seemed to have been what's worked best for me. So I like the 10 on the minimum side. So it's at least 2 weeks long, but no longer than 30 days. So a little bit shorter trend. So that kind of gives me the month period, right? So we're going to find at least 15 years of history. Now you can make that less if you'd like to, or you can make it more if you'd like to. But again, 15 kind of works out for me pretty good. So I'm going to come in here and say that the market, this stock has to have been profitable 80% of the time over the last 15 years. All right. Over the last 15 years, 80% of the time it has to have risen, because we're going bullish, in the month of March. That's what we're looking for. That's what the filter is going to be, and that's what the AI system is going to go out and find. So we're going to remove same symbol duplicate start dates, and we're going to remove the same symbol overlapping dates, because we get a lot of overlaps in there too, right? So we're going to filter those out. So we're going to go ahead and say, okay, all right, AI system, go out there and scan the S&P 500 for markets or stocks in the month of March that have won at least 80% of the time in the last 15 years during the month of March. That's what it's doing now. It's scanning. You can see that. When we first created this software, that scan would take about 2 hours, and we'd come back and it'd be done. See how fast that thing goes now? Computers are faster nowadays. Plus, we've been able to optimize the way we do this. So here we go. Now we got a score over here. That's the first thing I want you to look at. That score is something that we set up in here. If you come in here to your user preferences, you can see down here your weighting. Now, if you know much about AI systems, they build them around weights. All right. You hear them talk about it all the time. How's your AI weighted? So we have weights in here, and you can actually change these if you want to. All right. We've done a lot of work to kind of figure this out, but if you want to make changes to it, you can. So it's the volatility of return is 35 of the weight. The average return is 15%, accuracy is 15, and the drawdown is 35, and that gives us a total of 100%. You have to have 100%, but you can change those, whatever's most important to you. If you don't want much of a drawdown, you can reduce that, and then it'll give you less symbols that had drawdowns during their however long time period. All right, so these are all your settings in here, and that's how you can modify your AI system. So it's pretty cool. So what we've done is we've got a score now, and we set that score up, and 5 is the highest you can get. Now, that's pretty cool. We got a lot of 5s in here. Last month, we didn't have hardly any 5s. So 5's the highest you can get, and it comes down here, and you can see we got greens all down in here. We keep coming. We're going to get down into some yellows. So there's some yellows, and we'll come down in here. And we've even got some reds down in here. Now, once we get to the reds, let me slide down here a little faster. There's the reds. Once you get to the reds, now the reds don't mean that they're bad trades. It just means they're not as good as the greens as far as our weighting was concerned, right? So we like to kind of stick with the greens, and that's, where we're going to spend most of our time. So now we're going to come in here, and I like to sort this. You can click on the header, and you can sort it by anything you want. You can sort it by the start time. That's what I like to sort it by. I like to see what's coming up next. So we're going to have March 1st. And then March 1st, we got two greens right at the top, right up there. See those two? March 1st. Now, March 1st is coming up this Friday. And so that's when this trade starts. And it ends on March 14th and March 15th. 80% of the time, that's Equinox is the first one in the list. Over the past 15 years, has returned 3% on average. 3%, and it's okay, right? Over a 14-day period of time, 3%. That's pretty darn good. Now, the average profit is $30, but that's on a $1,000 investment. So you can see up here, that's no leverage. It's a straight up $1,000 investment with no leverage into that market, into Equinox, would give you on average $30. All right, man, I gotta drink some more tea. Hold on one second. Losing my voice already. All right, here we go. Let's go find some more greens. We can sort on greens. You know, another thing we can sort on is average profit. Let's bring the highest average profit. So you just click on that header. There's our highest average profit. That's 21% return. That's Builder's First Source. Between March 18th and April 29th, 80% of the time over the last 15 years, that's 43 calendar days, that thing's returned 21% on average. Now, if you look down there, if you look down there at your little table, at the bottom, you can see why it's got a yellow score, 1.62. That's because this high return, this average high profit, it's only happened in like three of the years. You got these big bumps in there for some reason. So that's why it gets a lower score. It's not that it didn't average 21%. It certainly did. And it's not that it didn't do 80% of the time over the last 15 years. It certainly did. It fits that category. But the reason it got 21% is because it had like these three spikies in there. So that's kind of why the system has weeded those out a little bit. If we come down here and look at the next one, let's sort again by start on open. So we come down here. Actually, we were doing average profit, weren't we? So we got 14%. That's Align Technology. Between March 21st and May 1st, 81% of the time over the last 21 years, that gave us 14%. But again, it's given us a 1.69 score, and you can see down there why, because it's kind of a little bit choppy down here where they're not real consistent. Got a lot of big ones, and they happened early on in the season too. It kind of died out towards the end, so it doesn't get as good a score when that happens. So now we come in here, we got Lululemon. All right, Lululemon's a 5, and that starts on March 19th, and that's got average profit is 12%. So it's a 12% return. Over the last 16 years, it's been 94% of the time it's been profitable between March 19th and April 5th, and it's got a 5 score. So we like Lululemon on March 19th. Now, I'm going to tell you, what am I going to be looking at on March 19th? I'm going to be looking at Lululemon. Now, if you have Lululemon, it's a great time to own Lululemon. We could go up and do bearish and find out which ones we shouldn't be looking at, but this is one we should be. So we're going to get a 5 on that. We're going to click that one. We're going to add that one to our list. That's a good one. All right. We like that one. Found that one. Next one, we want to come down here. We got some high returns in here. Here's 12% with a 4. Here's another 5 right there with 11%. What's that one? Equinix. March 19th. Between March 19th and April 30th, 83% of the time over the last 18 years, that thing's returned 11% in 43 days. That's pretty darn cool. All right. So that's a pretty cool stock. We might want to take that one. It's got a whole high score, and it's in March 19th, 83% of the time, 11%. Let's just come down here and scan real quick, see if we got any more high scores. There's a real high score, Chipotle Mexican food. March 19th to April 20th. 94% of the time over the last 17 years, 32 calendar days, that thing's returned 10%. These are all the high returners. All right, turners, get that? The high returners. All right, we're going to come in here. You think I had a 14-year-old sense of humor? Find humor in the silliest things. All right, come in here, and we're going to go back, and we can sort by other things besides just your average profit. Let's search by years. Okay, let's bring all the high years up. Look at that, 53 years. Chevron Corporation, between March 27th and May 7th, 81% of the time over the last 53 years, this thing's returned 5%. It's only got a low score, 1.42. And I'm not sure why it scored it like that, but let's go stick that one in our little note thing anyway. That's a pretty cool one. We also got ConocoPhillips down here that's doing a really, it's got a higher score than Chevron. Between March 13th, 2024, April 12th, 2024, 83% of the time over the last 42 years, 31 calendar days, it's returned 5%. Let's take that one too. Let's click on it first, look at it. Yeah, you can see it's had a couple of real crazy days where it's, these are like candlesticks. So you can see how high it went, how low it went, where it opened, where it closed. And that's what that is. And so you can see we've had a few reds in there, but pretty cool stock. Let's take that one just for fun. What about that one's red, red, red. Here's a high green. WEC Energy, 87% of the time over the last 39 years, 3%. Now the return's not as high, but it gets a pretty high score. But you can see it's been pretty consistent. Now over the last 4 years, it's been pretty straight up. So that might be a good one. We could take that one. The reason that's scoring so high is because the majority of the profits are in the most recent years, and that's good, right? All right, so now let's come in here and let's sort by winners. Let's just see how high we can get. Oh, there's a couple of 100%ers in there. Look at that. There's Sempra Energy between March 13th, 2024 and April 24th, 2024. 100% of the time over the last 25 years, that thing's returned to on average 7% between March 13th and April 24th. That one scores a perfect 5. We're going to take that one. The next one in here, March 28th, 24, April 22nd, 100% of the time over the last 18 years, 26 calendar days, it's returned on average 8%. Let's take that perfect score 5. Let's just take all these perfect score 5s, all right? 5, 5, 5, 5, 5. They're all getting 100%. That one's 95%. There's another 100%er. There's a 100%er right there. Oh, that's 94%, but it's got a perfect score. Ulta Beauty between March 20th and April 20th, 94% of the time over the last 16 years, that thing's returned on average 9%. I think we got a pretty good little selection of stocks here. We don't need to get too many because, this is just a demonstration. So we're going to go through and pick a few out of here and go take a look at them. So now I've selected those along that left-hand window. You can see I can come down here. There's all kinds of things you can look at. I mean, we're just looking at a few of the most important things, but you can see all kinds of stuff out here. I mean, we got max drawdowns, average draws, total wins, total losses, trading days, quantities, total historical profits in dollars. We got everything in here you can imagine. We've even got whether it's optionable, what sector it is, what industry it's in. We got all kinds of information. Everything we can imagine we threw in there, all right? So we got all that stuff in here. Now what we're going to do is we're going to come over and we're going to bring those into the neural network. So we're going to go into the step 2, and there they are. Because I selected them over here in the left-hand side, they're now up here. So now we got them in here. Now this is where the neural network is going to go through and it's going to analyze just these individual ones. And I'm going to go ahead and tell it to go ahead and see if it's going to only look back 15 days. Because once, the further out they are, the not as good a calculation. We don't have as much information. The closer we get to the day that the starting date. So the closest one we got is March 11th. And we're 15 days so we might get a couple of them to calculate in here. And that's about all we're going to get. Because 15 is as far out as we can look in the future, have AI look out into the future and see if it can't figure out which ones of these is the best. Now, what it's going to do is it's actually going to go out and create fingerprints. And it goes out and it creates fingerprints for every single one of the years in the past. And it creates a fingerprint. It says this fingerprint was a really big year. This fingerprint was not so good. Oh, this fingerprint was a little bit lower. Oh, and this fingerprint was a loser. And then it comes and it makes a fingerprint for this year, and it compares this year's fingerprint against all the past fingerprints. And it says, which one does it look like the most? And then it'll give you a ranking and tell you whether it thinks it's going to do it again this year. Now, this one, it says medium, this is high, this is low, and this is high. Now, again, we can only look out 15 days. And you want to run these like the day before you're going to get in to see how this probability turns out. But nonetheless, it's just how the AI looks at it and says, hey, I don't know, it's kind of looking like a winner or it's kind of looking like a loser. from what we've seen in the past. So this is 1 day until calculation, 2 days, 8 days, 9 days. It can't calculate that one for another 10 days. And then it would still be 15 days away. So it's quite a ways out there in the future. Even these are, we got, we're a few days out on March 11th. That's barely going to make it out there. So you're going to want to run this again when it gets closer. That's all I'm trying to say. So we're going to take all these. We're going to just take them all. All right. So let's just come in here and we're going to say select all. Remove all, remove. How do I select all of them? I think I just highlight it just like we do in any good Microsoft program. And we're going to add to pick list. So we come in there, we add to pick list. That takes us over to step 3 in the portfolio. And in the portfolio, you have 2 windows. You have the upper window, which is the pick list, and you have the bottom window, which is the portfolio. So now we're going to have, again, we're going to come in, we're going to have AI pick its favorite ones out of here. And I kind of like to kind of sneak them in here. You could come in here and say, well, I want to have your 5 best. Okay. And you come in there and you say, I want to have 5 best. And so you say, I'm able to add up to 5 additional trades. I would like to add 1 additional trade now. So I tell it I only want to see 1 at a time, because out of the 5 that we're going to pick, I want it to pick its very favorite one. I want to know what its favorite is. All right. So this is the AI system picking these stocks out of these lists. So you can see how we kind of narrow it down. And then it's coming in here. It says, when auto selecting trades for your portfolio, only include trades where the probability have been calculated. That's this probability table from the neural network. Okay, so you can say yes or no on here. If I say yes, it's only going to look at these top 5, 1, 2, 3, 4, actually top 4. So I'm going to say no on here and let it look at these out here as well. So we're going to ignore the probability table. We're just going to look at everything else and have it decide. It's not going to take probability into consideration. It's just going to look and say, I wonder what my favorite one would be if it wasn't for the probabilities. And I want to just have it pick 1. So I hit auto select, and that's its favorite one. 2 days until calculation. It's the Mondelez International Incorporated. All right, MDLZ, between March 20th and May 1st. 95% of the time over the last 22 years, that thing has returned on average 6%. Then it got a perfect 5 score. And look at that. Look at that equity line down there. Look at that thing. Woo, that's beautiful. Okay, that's our favorite one. So MDLZ. Let's go pull it up and look at it. MDLZ. I'm sure you guys already have it on your screens. MDLZ. And there we go. That's MDLZ. And so this is the stock that it's recommending that we pick up, but not until, right? It says between March 20th to May 1st. Doesn't mean you can't get in early. If you look at it and you're saying, hey, I think this market might rally before. Start a little early. I'm getting in now. You can do whatever you want. It's just tells you that 95% of the time over the last 22 years, between March 20th and May 1st, that thing's risen in price. Now, what it's really telling you right there is on March 20th, you go find that the opening price on March 20th, and on May 1st, it'll be 95% of the time it's been above that opening price. That's basically what it's telling you. Okay, it's kind of like drawing a line in the sand, saying it'll be above this price by this price 95% of the time over the last 22 years is what it's done. So March 20th is going to be our start point. March 20th. So let's go look. And I like to draw a little box, or you can draw a line, but I'll draw a little box. March 20th. We'll come out here. March 20th. Find March 20th on the calendar. There it is. And we start to bar our box. And we need that box to be green because this is our green. All right. So that's our green box. And then I like to find what's the last day? May 1st. So we'll come out here, April, May 1st. So that's kind of our gateway right there. And okay, so I don't need that value in there. All right, so there's our box. Okay. So there's our box, and that's what that thing's telling us. We could probably come in here and look at it from a dollars calculator. We could say value. We don't want value. We want percent. There, it's giving us our percentage. So it said on average, that thing returns 6%. So we'll come back here and we'll draw this down here, about 6%. So that's kind of the move. That's your box. So that's what it's telling you. It's saying that sometime It's going to come wander around in here, whatever it's going to do. Nobody knows, nobody knows, nobody knows. But somewhere in here, it's going to go like that. It's going to come up and do something like that. So it's going to be on a rally in there. That's what it's telling you. Now, I like to come in and do my technical analysis, and I like to come in and say, okay, where am I at in my technical analysis? Here's drive 1, drive 2. I'm going to look for a counter trend. I'm going to look for drive 3 right in there, and that's what I'm going to look for. If that all corresponds with my technical analysis, that's when I'll look to be trading. If I'm looking at technical analysis and my technical analysis doesn't match with the seasonals, I'm going to be very cautious and careful. But if everything looks like it's all lining up, like, oh, man, yeah, it's going to be a nice A drive or a B drive, and that thing's going to go right through that line on that B drive. That's where I back the truck up. All right. I load it up. All right. Let's go look at the next one. So that's Mondelez International. Let's come in here and ask it to tell us one more. What's its second favorite? All right. Second favorite. I'm going to go ahead and say auto select. Oh, it picked 2. I didn't want it to pick 2. Which is your favorite? Well, it picked COP and it picked KDP. All right. We'll take these 2. This is Dr. Pepper. All right, that's we looked at Pepsi, we looked at Coca-Cola, and now we got Dr. Pepper. So let's look at that one. Between March 14th and April 3rd, 100% of the time over the last 15 years, that thing's returned 4%. Now, it's had a pretty wild year in 2020. It went all over the place. But let's go look at KDP, March 14th. KDP, March 14th. Let's draw our box. March 14th. There it is right there. And it said it's going to be a bullish trend right through here until what was the closing date? April 3rd. Now, just because it has a closing date of April 3rd doesn't mean you have to get out in April 3rd. It's just telling you that this market's going to have a tendency to be going this direction during this time, during that box. All right. So if this market looks like it's going to come down, well, it looks like it'll probably come down, drive 1, drive 2, probably catch right down in here somewhere, right? Maybe have a little bobble down in here. Who knows? But then it's going to probably rally during that time frame. That's what it says. We're going to get a little bit of a retracement. You come put your Fibonacci ruler on there, draw that in there. This thing's coming right down into these Fibonacci sweet spots, bouncing down off this lower point right now at 61.8. This thing looks like it wants to turn and go off that 61.8, and it says it's going to do it during that time frame. So even when it turns, wherever it turns, go through that time frame, it's going to be higher. That's what it says. So we'll see. We're going to follow this baby along, see what it says. What was the next one? That was Dr. Pepper. The other one was Conoco. So that's COP, and it's March 13th to April 12th, 83% of the time. So March 13th. So we're going to go look at Conoco COP at March 13th. COP, and I'm going to draw my box. March 13th. Let's give us a little room here. March 13th. Oh, I didn't see what the closing date was. March 13th to April 12th. April 12th. All the way up to there we go. That's what it's telling us. That baby's going to come out here probably. We might see it just go right up through there, just like that. There's a nice little natural trend line. Boom, just like that. Just like we did yesterday. Let's do this little thing we learned yesterday in class, right? We click here. We right click on it. Boom. Give us an extend the line. There you go. There's your trend line. So that's what that thing looks like. So if it stays in that trend, of course, we do have a trend coming down the other side too. So we come down. If we want to click on it, do it just like that. Right click, extend line. Gives us that little triangle formation. Of course, you can use this tool as well. Boom, 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 just like that. Pull that thing out along those trends, and it gives you that nice little trend line in there, and there you go. So now you have yourself a little triangle formation, and it looks like it wants to correspond with that box right there. What that would mean is we'd need to see this thing just go right up through it, just like that. Of course, it's not going to go straight. Don't expect things like that. Move like this, okay? So that's what we're going to look for. So there we go. That's our top three. COP, KDP, and MDLZ. There you go. All picked by the AI system for you. So if you love AI, and you want to trust in the AI system and in the historical nature of recurring seasonal price patterns, those are some good trades for you right there. We're going to follow through with those, and we're going to see, and we'll keep up with this, and we'll see how they turn out. All right. So come back tomorrow and we'll do it again. But well, not tomorrow on this one anyway, because these don't start until, we got next week we'll come and look at these. All right. So, all right, guys, that's it. Let's go over and look at Kramer real quick while we're here, because Kramer told us what to trade, right? So we put some stuff on Kramer. Where is he? ABC Kramer right there. This is our Kramer stuff. Didn't we put some orders on this Kramer? Am I in the wrong? I might be in the wrong book for Kramer. Or did we call him Jim Kramer? Jim Kramer picks. There they are. All right, this is the stuff Jim Kramer picked last week, and we went and looked at. So he had Amazon on his list. We didn't put an order on Amazon. We just analyzed it and took a look at it. And this looks like it's getting ready to break higher. I think the reason we didn't put anything on Amazon was because it was already at the top of a third drive, right? Drive 1, drive 2, drive 3. And that's a little scary for us as small speculators. We want to see it pull back into a red zone first. So we want to see one of these right up in here or down in here or something. And then we'll be buyers on Amazon. We don't want to really buy right up there, even though Kramer says we should. Doesn't mean we should. We're a little bit more scientific about this, right? We have our scientific wild ass guess. We don't just want to wild ass guess into these things. So that's Caterpillar. Now, Caterpillar, it was at the top of the second drive, right? This is drive 1, counter trend, drive 2, and we're going into drive 3. And that's why we went ahead and we put our position on right there. So that thing's taken off, up 112.50 on that option. We got coffee, or Capital One. Now we put on what do we do here? This thing's just going sideways. We bought a call and we bought a put because we weren't real confident this thing was going to go up, right? So we bought a put as a little bit of insurance to protect us to the downside. Now the market's not done anything, just gone sideways. So we got one big long drive here. We got a counter trend here. We got another little drive here and another drive here. And I think we counted this as the A2, drive 1, drive 2, drive 3, and that's why we were cautiously approaching this one. Let's come in here and see what DFS Financial. Same thing. Market's not really done anything. We haven't had time. We only did this a couple of days ago. But we bought a call and we bought a put. The put is only 17 days. The call is 115 days. So we got some time for it to rise. But we just put a little bit of insurance on there just in case it dumped right out of the gate. If it just dumped, we'd have been, take away a bit of the pain with that put option. That's why that's there. Disney, we didn't put anything in on Disney, but that's what Disney's done. It's pulled back. It's just kind of done nothing too, same as the others. Now, this is one that's kind of painful. We're down $235 on that 115-day option. That market we thought might have a little bit of a run in it. Counter drive 1, counter trend, drive 2. It's coming down. We probably should have waited until we got a little bit of a break on that blue light and then go. But we got 115 days, so we'll see. If it comes down here a little bit, we'll measure that with our Fibonacci ruler from bottom to top. If it comes down into the sweet spot, we'll buy another one. All right, we'll pick up another one down in here and ride 2 of them out. How's that? That's why I start with 1, because if it pulls back a little bit, you got that option to pick up a second one on a pullback. All right, and then this is that one that was a little crazy. This was the one that's a little crazy. We talked about this one for a little while. Decided to put a call on there, just throw one on there and see how old Kramer's suggestion goes for us. We're down 105 on it right now. We got Home Depot. It's one we should have probably put one on, right? It's the only one that's really taken off, and it's one of the ones we didn't buy. So it broke above those blue lines, broke that high right there. And that baby's rallied up a couple bars since then. So we got NVIDIA getting ready to go to the moon again. A2, AB, AC. A lot of people are saying, when are we going to get out, take profits on NVIDIA? It's been going crazy. Problem with it is $789 per share, right? And so if we come in here and look at our options, to buy an option out here, and if we wanted to buy one even with just 100 days on it, that's $8,000. The question is, do we want to do that? Do we want to put that baby on there? Okay, there you go. We put one on there. See what it does. Okay, here we go. Vizio. This is one that we didn't put a position on either. It's coming into that little wedge formation. And It's not broke out yet. You could put one on there in case it breaks, put your put option on there in case it flushes, because we don't know which direction it's going to go. It's just going sideways right now, trying to make a decision. We got Walmart. Again, we didn't put one on Walmart as it broke above the previous high. Kind of waiting for it to give us a little bit of a pullback in here, see if we can't buy low, sell high, and then we'll go like that. We may not get it, may not happen, may just go to the moon and we'll feel bad, but that's the way these games work. All right, here we go. Here's Win. We're looking for it to rally. We also bought a little insurance policy. We bought a little 17-day put on there just in case that market flushes, just to take away some of the sting of having that thing lose money on our call. All right. And since the market's going nowhere, both of them are losing money. We're down $18 on one and $35 on the other. That's the thing about options. They need to move. If you're going to buy trade options, you need markets that are on fire. All right. All right, guys, I hope that was fun. Any of you have any questions? I don't see a whole lot of comments other than good morning, good morning, good morning. It's great to see you guys all in class. Anybody have any quick questions before I let you go? Looks like we've run out of time. We could jump back over real quick here just to take a look and see what the futures markets are doing, because we all love futures, don't we? We'll pull that up here real quick. Take a look and see what our futures market's doing. Just to close the day out. Well, we didn't get our ABC pattern out of the Russell like we were hoping. That thing just died on us. Came down a couple more bars, bounced, and just went sideways. Good thing we weren't trying to trade this market today. Man, we got our hiney handed to us. We'd have had our losses. Right out of the gate, we got that reversal. So that was our morning bell that we were looking at right up here. So that was the rally up. And that's why we don't just jump on these things and say, it's going upland, buy on that opening bell. Because look what that thing did. It turned around and flushed like a toilet. Now, it would have been a good reversal trade. We could have got in and got the reversal. That was a big move. From this reversal to down, just let's say down to this yellow line, that was $295 on a $1,000 investment. So not too bad. And then it just died. So what we're going to do is we're going to come back at 9 o'clock. We haven't looked at the news. We have to always look at the news, right? See if there's any news. Let's do that quick together. So today's Tuesday, 6:30 a.m. We had durable goods. And it was down 4 was the forecast, and it was down 6. Ooh, that's bad. And that's why the market tanked. All right. Durable goods, orders. Forecast to be a positive, and it was a negative. Durable goods orders. Defense, down 7. Non-defense, 5-1. 7 o'clock, we had the Schiller home prices come in. That's not a red, but 0.1, 0.3. They went down more, so that's good. People start buying homes. House price index. Fed bar speaking. What's going on? 9 o'clock, 8:30. Dallas Fed services, nothing really there. That's it. We can go look at oil, crude oil, but that's not coming up till 2:30. That's when the market's closed. So we got 7-year notes coming out at 11. That's not going to really do anything for us. All right, guys, not a whole lot of news, so it'll probably be a little bit of a quiet day. Be careful. Don't go crazy. There's not a lot of reasons for these markets to flush and run, other than, to run, I guess. Got a good reason to flush because we had some bad news come in or not so good news on the durable goods, but that's why we got this dump right here. That was a news event. Durable goods dump. That was an over exuberant rebound. Now it's going sideways. I would expect this thing to fall again. We could put a put option on up here if we wanted to on this triangle. Or we could at least come in here. Probably not going to get, since we got bad news today and the market's just going sideways, probably not going to get a big rally. So if Michael Bruce is in the house, Michael, you might want to put on we could come in here and drop one of these in. Vertical spread. Let's do a 0 DTE call per vertical spread. So we're going to sell a call, see how much we can get out of this thing. 122, 65, 122. That's 172 right there. That means it couldn't come up at all. We'll play a little 122. We're going to go in here and we'll buy a call. Buy a call up here. 2 clicks out. Let's do 2 clicks out. That's $35. So make about $100. It's about what we made yesterday. All right, in our option. And the thing is, you look at that and you say, $100. I don't want to wait all day to make $100. Well, come in here and put 10 of them in then. That's the whole idea of this thing, right? You can scale it up. All right. Now you're going to make $1,000. Is that good enough for you? How much they're going to? I'm going to have to put $4,000 up. That's your margin, $4,000. So you invest 4,000 to make 925. I don't want to have that kind of reverse reward ratio. Yes, but look at your probabilities. There's your probabilities right there. Wow, you got to look over here on the calls to get your probabilities. Here they are. You got a 77% chance that thing's going to pay off. 77% chance. Now it's early in the morning. You could wait if you wanted to, but by waiting, that's how you make money, time. And if it just keeps falling, then that's where you make all your money. If you wait till noon, then you won't make as much money. You're already complaining that $100 isn't enough. So there's $1,000 by doing 10 of them. What's your max loss? Well, they're going to margin you at max loss, which is 4,180, which would be if the market closed, in this case, hit that line up there. If it closed above the green line and hit that purple line above the green line. So if it hit up there, that's where you'd have max loss, 4,180. All right. Anywhere in here, it's going to have something less than 4,180, but it's going to still lose. It's going to lose. It's still going to lose. You're going to lose everything. All right. Just you're going to have a little bit of money in here. It's going to take away some of the sting, but not so much. And if you wait for it to, it's got to go. It's got to go above it to make any money. Because if it comes down here, it's not going to make any money at close. So keep that in mind too, because this thing expires on 0 as well. So that's your game. That's a 22% return. If this thing, all the market has to do is it has to just stay below that red line. It has to hit that purple line underneath that red line. If it does, you get your, however many you do, your $100 times whatever your quantity is. So you're going to do 10 of them. That's a $4,000 run. Okay. Maybe you want to do 3 of them. Maybe you want to do 5 of them. Maybe you want to do 20 of them. I don't know. What's your account? Remember your risk reward ratios and your risk management. We'll do 3 of them on here. That would be $277. Let's go ahead and we'll throw that on there. And if the market takes off and runs, we may have to roll it. And if we roll it, we're going to have to add some to it. That's why you don't want to get too heavy on the first one, because if you have to roll, you want to be able to have some in reserve that you can roll this thing out to. So, and if it drops real fast, I mean, if it just flushes out the bottom here, you could get your money quick and take 50% off right out of the gate. You just come in here and say, liquidate the multi-leg and say, I'm going to take 50% of this thing off right now. So we come in here and set that in there. Net profit 50%. We're going to take 50% of our profit. That would be 142.50. You go ahead and hit place that. Now you got your order sitting there. If it gets 50% of your value, well, it'll take it off and it won't have to go all the way to the purple line. Might do that in the next hour. Who knows? All right. That's the name of the game. That's how we're going to put on a vertical spread on this thing. And we put a couple of options on over there in the stock market, and we've reviewed and we've looked at our seasonals. So I think today's a pretty good day. And if any of you have any questions, let me know. I got one little lesson for you. Remember with this guy here, old Elon Musk, he says, making an extra 10,000 is easier than saving 10,000. The sooner you understand that, the sooner your life will improve. All right. Richest man in the world. Probably take some advice from him. Probably knows what he's talking about. All right, guys. Go get Pit News Magazine, subscribe, and we will see you here tomorrow. Same bat channel, same bat cave. You are Batman, right? I am Batman. Who's Batman? You're Robin. I'm Batman. All right. We'll see you guys tomorrow.